My name is Jeff Lester. I'm a financial advisor with Eide. I specialize in working with retirement plan clients who are clients of the CPA firm. So I'm going to show you our required disclosures that tells you that we are financial advisors through Eide and have a broker-dealer affiliation and so forth. So now that you've seen that, we'll talk a little bit again about what we're going to accomplish today. I work with CPAs across Eide, across the firm, in helping with plan design ideas and implementation of retirement plans for clients of the firm who are business owners and who want to try to take advantage of the value of a retirement plan as a tax savings tool, and also as a tax deferred wealth accumulation tool for retirement plan purposes. So what we want to do today, we have kind of three major objectives. One is I'm going to provide you with an overview of some general rules that sort of broadly apply to all types of retirement plans. And there are always a couple of one-off exceptions. But if I give you sort of the broad rules, then we'll be able to distinguish between some of the different plan types as we move forward. Second thing is we're going to introduce you to the two major types of small business retirement plans, and then finally give you an overview of basic characteristics of each type of plan. So at kind of a high level, there are some general rules that apply to all types of employer-sponsored retirement plans. One is the compensation limit. So with regard to the amount of money you're allowed to put into a plan and the calculations for things such as profit sharing, salary deferral, and so forth, the maximum amount of compensation the IRS will allow you to consider is $280,000 for 2019. So if you earned $100,000 as a business owner, we consider the $100,000. If you earn $1 million, we only consider $280,000 of that. And that's one of the things the IRS does to sort of level the playing field for participants. Penalty for early distribution or withdrawal. You've probably all seen or heard of this previously, but if you have money in a qualified retirement plan, you take it out prior to age 59 and a half, you're typically going to pay an excise penalty or a 10% penalty tax, as we sometimes refer to it, which is additional tax on top of the ordinary income tax you would pay for those distributions that you take out. Now, I told you there are one-offs. There are a couple of different types of government-sponsored plans where that age limit is lower. But generally speaking, if you're in the private sector and you offer a retirement plan, any money that comes out prior to 59 and a half is going to be subject to income tax and penalty tax. Required minimum distributions from most retirement plans begin at age 70 and a half. Doesn't matter if it's an IRA or a 401k or what it is. And that's generally the rule. Business owners don't get quite as much favoritism beyond 70 and a half as your rank and file employees do. There are ways that some employees, if they're working for you full time, they're continuing to have earnings beyond 70 and a half, they can actually delay having to take those required distributions in some types of retirement plans until they actually retire. Unfortunately, if you're the business owner, you don't have that luxury. Pre-tax contributions obviously help reduce your taxable income, and they are tax deferred until distribution. That's why most business owners want to set up a plan, is to get the current year tax savings that's available through a retirement plan, and then also to get that tax deferred growth on their own accounts. And finally, all employer contributions are tax deductible to the business owner or to the business and are pre-tax to plan participants. So that's kind of how we're able to use this as a tax advantage tool for our clients. So there are two major broad categories of retirement plans for businesses. One of them is a defined contribution plan. The other is a defined benefit plan. So defined contribution in simple terms is where you are making predetermined contributions into the plan, a percentage of pay, or a specific dollar amount per pay period. And most of those defined contribution plans, whether it's a simple IRA, a SEP IRA, a 401k, most of those allow obviously for employer contributions. Most, but not all, allow for employees to contribute their own money. But defined contribution, because we're defining how much money we want to put into the plan. By comparison, defined benefit is a type of plan where there is an actuarial calculation. Think of this like an old style pension plan, where a calculation based on some factors like age, time to retirement, amount of income, allows you to save for a predetermined retirement benefit once you reach retirement age. And so there is a good fit for either of these types of plans for virtually any business, but they are not necessarily either one a good fit for any specific business. It's really kind of the whole crux of what we want to talk about today is some of the nuances of the different types of plans and help you learn enough that you could make an informed decision about what type of plan or what combination of types of plans might be best for you. So when we start talking about defined contribution plans, where you're determining how much money do I want to put in this pay period or this year, there are two types. IRA-based plans, which very simply are payroll deduction IRAs. We're not going to talk about those today. That's simply a way that you can set it up through your payroll for employees to contribute to their own IRA. And it's really just a discipline tool, assuming employees aren't disciplined enough to save their money and make their contribution once a year on their own. But we're not going to talk about that today. We're going to talk about the more plan level IRA-based plans, which includes a simple IRA and a SEP IRA. And for those of you who wondered what simple and SEP stand for, there's the terminology behind the acronym. There are other types of defined contribution plans that may sound more familiar, such as a profit sharing plan and a 401k plan. And when we get into the profit sharing and 401k plan, that's where we can do more to help employers figure out a more aggressive tax strategy and how they can take advantage of plan rules to really maximize tax savings. So I'm going to follow a similar format for each type of plan we go through, but we'll start with simple IRA. So this is something, the big advantage is it's a salary reduction plan. Your employees can put money into it. You as the employer also are required to put a certain amount of money into the plan, but it has very little administrative paperwork. It really comes down to setting up accounts and then making contributions into those accounts with each pay period. Any employer with 100 or fewer, this is a big deal with simple plans, 100 or fewer employees who does not have any other type of plan can have a simple plan. And I've put this in red. This is the only thing I've put in red and in bold in the whole presentation. You cannot have a simple plan and any other type of employer-sponsored plan during the same calendar year. Now, in theory, a participant could, because a participant could work for two different employers. One of them could have a simple plan and one could have some other type of plan. And if the employee works for each of them enough hours and has enough income to be eligible to participate, they could theoretically do that. But you as a business owner of one or more businesses, you can't, if you offer a simple plan, you cannot offer any other kind of retirement plan during that calendar year. So that's something to keep in mind. If you want to change, for example, from a simple to a 401k, there are rules that say you have to announce that formally, and there's a way to do that, to announce it formally by basically November 1st, prior to the January 1 that it's going to change. So that's really the biggest thing I want you to take away from a simple plan as a difference is you can't have it and another plan at the same time. And if you're going to get out of the simple plan, you have to terminate that plan, announce the termination before the end of the year. And then once January 1 rolls around, if you deposit a penny into that new plan with new payroll for the new year, you're stuck with that simple plan for another year. So there is a standardized IRS form to set up simple plans. Also, most of the major investment companies they have their own process for setting them up. As far as you or the employer are concerned, the big difference is if you use the IRS form, your employees can each have their account wherever they want it, each with a different fund company, and you've got to, through your payroll, make their deposits with each pay period to all those different fund companies. If you use one specific fund company to manage your plan, then all the deposits are made to the same place, and it's obviously a lot easier for you as the business owner to manage it. There's both salary deferral and employer contributions I already mentioned. You can put in as an employee up to 100% of your compensation, limited at $13,000 per year. Plus, if you're over 50, you can put in a catch-up contribution of $3,000. And then there's that employer contribution, which your choice as an employer, and you have to determine this before the beginning of each calendar year, of each plan year. You have to decide, am I going to put in up to 3% as a match for all my employees who put their own money in, or am I going to put in 2% of gross pay for every employee who is eligible, regardless whether they put their own money in? And it really is going to depend on your own circumstances and your own group of employees as to what's the correct answer. And that same concept applies to other types of plans we're going to talk about. But that's one of those things where you just kind of have to know your employees and run the numbers and decide which makes the most sense. So as we drill down a little more, employees choose how much they want to contribute, whether they want to start, stop, etc. And employer must either do the match or contribute the 2% to everyone who's eligible. You have to offer it to all employees who have compensation of at least $5,000 in either of the two or in any 2 prior years and are reasonably expected to earn at least $5,000 in the current year. So if you start a simple plan, for someone to become eligible, technically they would have to, with the most stringent rules, would have to work for you 2 full years and have earned at least $5,000 in each of those 2 years. And then in the 3rd year, they would begin to participate in the plan, assuming they were going to earn at least $5,000 in that plan year. You can be more lenient. So if you're a business owner and you don't have any employees, you can start up a simple plan and start contributing immediately. If you do have employees, you set it up and you want to start immediately because you want to put your own money in, well, you have to make that same exception to all your employees as well. So just keep in mind, whatever you do that's the most lenient for one applies to all. Withdrawals are permitted at any time subject to federal income tax. Early withdrawals in virtually any retirement plan prior to 59.5, subject to that extra 10% tax penalty. However, simple plan, that tax penalty is 25% if the account has been open for less than 2 years. So let's say you started a plan on simple plan January 1 of 2019, and the first payroll deposit went in on January 10 of 2019. If someone wants to take money out of that prior to January 11 of 2021, they're going to pay taxes and a 25% tax penalty. So the 2 years is extremely important. You don't want to take money out prior to 2 years. And in that first 2 years, even if you change plans, the only thing you can do is move that money from one simple plan account to another in order to avoid that 25% tax. Immediate 100% vesting of all contributions, meaning the money your employees put in and the money you put in, it's all vested immediately, 100%. So a simple plan is a good fit for employers with 100 or fewer employees who have at least reliable enough cash flow that they know they can either do the match or they can make that 2% contribution to their employees if they choose to do it to all employees who are eligible. So it's pretty easy to do, and it's pretty inexpensive. So we arrive now at our first polling question. So I'm going to give you a second to read through it. Withdrawals permitted at any time, subject to federal income tax. Early withdrawals subject to an additional penalty. 25% if the account's been open less than 2 years. Loans are not allowed. So what is the penalty, the additional penalty tax of X? So you're right, you're either going to pay a 10% penalty, or if it's in the first 2 years, you're going to pay a 25% tax penalty. So either way, you'd prefer not to pay that penalty, so you encourage employees to wait until they're at least 59 and a half to take money out. So SEP IRA plan. This is another one that's popular, especially for some sort of sole proprietor or one-person business owner businesses. Easy to set up and maintain because really it involves a single account for each participant. Basically, any employer can set up a SEP. There is an IRS form that you can use. Again, you can go straight through a financial institution and they're going to have their own forms in order to set it up and to keep it simple for you. SEPs are employer contributions only. Employees don't make contributions. Now, there used to be a type of SEP plan years ago called a SAR SEP that allowed employees to put money in. I've seen one of those in my career that's still in existence. But if you set up a SEP now, you don't have that choice. It's employer contributions only. The max amount you can put in is up to 25% of gross compensation, but no more than $56,000 for 2019. Now, a caveat on that is if you are a self-employed business owner, you can only put in effectively 20% because there's a special calculation for self-employment. So kind of keep that in mind as well. Employer can decide from 1 year to the next whether to make contributions. That's a big advantage because you are not committed to have to put money in every year. You can actually wait until after the tax year has concluded and figure out if you have enough cash flow to support it and then make the contributions. You have to offer the SEP to everyone who's 21 or older, has been employed for at least 3 of the last 5 years and had compensation of $600 per more in each of those years. Again, though, if you make exceptions and you're more lenient for one on the entry requirements, you have to be more lenient for everybody. You cannot go back. It's a one-way door. Withdrawals are permitted at any time, subject to federal income tax. Early withdrawals are subject to the additional 10% tax penalty. This one, it's just a 10% tax penalty. There's no additional beyond that. And then there's immediate 100% vesting of all contributions because it's all employer contributions. SEP's a good fit for business owners who have high income. And when I say high, I'm talking, at or around that $280,000 compensation limit. The reason is if you have that kind of high income, you can maximize your own contributions into the plan. So it's especially good for sole practitioners with no employees, or maybe for business owners who have only 1 or 2 or up to maybe half dozen employees. But especially if you have employees where the business owner has high wage disparity, earns a lot more than the employees, and has wage disparity. So what that would basically mean is the best fit would be if the business owner earns around that $200,000 to $280,000 range, and maybe all of your other employees combined earn that or less. That's kind of the ratio when we would start saying maybe a SEP is a good fit for you. Remember, though, the contributions are a percentage of gross compensation, and in a SEP, that percentage has to be the same for everyone. So if you put in 20% for yourself, you have to put in 20% from the business to each of your eligible employees' accounts as well, 20% of their gross pay. So if you put in 10, you put in 10 for your employees. It can get really expensive in a hurry if you have multiple employees and if your employees have very high wages, because you're capped at 280 that you can use for the calculation for yourself. So SEP may sound really great, but I would discourage you from just jumping into it abruptly without making sure it was really a good fit based on the numbers. If we take a step up from the two IRA-based plans, the next step would be a profit-sharing plan. And in many ways, a profit-sharing plan and a SEP are similar because it allows the employer to make large contributions. Any employer basically can set up a profit-sharing plan. There really isn't a model for this, but because there is testing, non-discrimination type testing involved, and some other requirements like filing an annual Form 5500 with the IRS, you need a third-party administrator to design your plan, create your plan document, and administer the plan for you. In kind of rough numbers, third-party administrator for a small business of, say, 25 or fewer employees, third-party administrator could cost you anywhere in the range of maybe $1,200 to $2,500 a year in really loose round numbers. Could be more, could be less. But that gives you an idea of kind of what the administrative expense might be. However, an advantage here is it's all employer contributions, but because the calculations are derived in a different way, they don't have to be the same contribution amounts for everyone. And this is where age disparity between the business owner and wage disparity both become factors. And so, for example, an older business owner, older than their employees, the bigger the gap, the more the advantage is to the employer's own account. The same with wage disparity. So you can actually afford a profit sharing plan to make those contributions typically better. It's typically less expensive to do that with the same pool of employees than it is to do it with a SEP. However, you got to take that administrative cost into consideration. So it's something you do want to drill down in and make sure you understand the numbers before you just jump and do it. Again, like the SEP with profit sharing only, you can put in up to $56,000 per year into that plan per person. So the employer chooses annually whether to make those contributions. It's discretionary, and you get to choose that after the year is over. So typically I see small businesses making the profit sharing decision in February, March, April, after the previous calendar year is already ended. So right now there are a lot of business owners making profit sharing contributions for 2018 because as the business owner, you're allowed to make those contributions all the way up until the extended tax filing deadline for the business. And if you extend, of course, for the business, that would be until September. Generally have to offer it to all employees who are age 21 or older and worked at least 1,000 hours during the previous year. So that's kind of the qualification. Age 21, worked at least 1,000 hours, and then the following year they typically would become eligible. Although there is room in a profit sharing plan to be more specific about those requirements. Withdrawals are permitted after a triggering event. Triggering event would be retirement, termination of employment, plan termination, etc. Of course, profit sharing money could be rolled over into an IRA or other type of retirement plan. All that is still subject to that 10% tax penalty if you withdraw money from a profit sharing plan prior to age 59.5. And you can apply a vesting schedule. And of course, if I were recommending to you to set up a profit sharing plan, I would absolutely recommend you use a vesting schedule because a profit sharing plan is an opportunity for you as the business owner to dangle a carrot in front of your employees. And in order to get that carrot, they have to be a loyal employee who is with you for an extended period of time. And that's where the vesting comes in. So it's a risk reward opportunity for you and them. If they commit to your business and are there for a long time, the vesting applies and they're able to get more of that profit sharing contribution. Good fit for business owners, again, who have high income, so that you can maximize your own contributions into the plan. And this is especially true for sole practitioners who have no employees or only a few employees. And if the business owner has substantial wage disparity and age disparity when compared to their non-owner employees. But again, you need a good third-party administrator, TPA, to use the lingo, to help make sure that your plan design is best suited for your circumstances. So the next step then would be a 401k plan. And for those of you who have no one's ever told you this, Section 401k of the code is the section that applies specifically to allowing employees to make salary deferral contributions into a plan. So a 401k plan is basically a profit sharing plan with the ability for employees to contribute. Big advantage here is that you and your employees can both make contributions to the plan, and with the profit sharing component, you can make really high contributions. Employer eligibility, it's a good fit for just about any employee or employer who has the cash flow to support it and the interest in maxing out their own contributions. You need a third-party administrator to do your plan design, to create your plan document, and to do that annual testing. And of course, you have to file an annual Form 5500. And typically, your TPA is going to prepare that 5500 for you, and all you're going to have to do is sign it. Contribution types. Whoops, I rolled forward too far. Now we go. Contribution types. So it allows for employee salary deferral and, of course, for your discretionary profit sharing contributions if you choose to do it. So you can have a 401k plan, and it's simply employee salary deferral. You never do profit sharing. The profit sharing piece is always discretionary. Although for a lot of really small businesses where you've got, say, 20 or fewer employees, it may be very lucrative for you as the business owner to consider doing the profit sharing, and that part's discretionary. So you have a good year, you could do a profit sharing contribution on top of the salary deferral. You have not so good a year, you could skip the profit sharing in a given year. With regard to the amount of contribution you can put in, employees, including the business owner, you can defer through salary deferral up to $19,000 per year per person for 2019. Plus, if you're over the age of 50, you can put in an extra $6,000. So let's say you're a business owner, you're over the age of 50. Just through your own salary deferral, you can get $25,000 into the plan. Now, what that means is you can get $56,000 in, including profit sharing. So combined employee salary deferral plus employer profit sharing. But if you do the math and you say, well, to get to $56,000 in my own account, if I put $25,000 in as salary deferral, then the profit sharing would be only another $37,000. So what you can really do is, with a lower total compensation amount for yourself, actually get more into the plan than you can in just a profit sharing plan or in just a SEP or a simple. And it's because the salary deferral allows you to get part way toward that plan limit with the salary deferral component. And oh, by the way, the catch up here doesn't count toward the max. So you can get salary deferral and profit sharing combined of 56, and your extra catch up can take you all the way to 62,000 in 2019 if you're over the age of 50. Employer, so you as the business owner, the business, you can only deduct up to 25% of the aggregate compensation for all your eligible participants. And obviously you get a salary, or you get a tax deduction for all the payroll that you pay. So there's a lot of tax saving opportunity in a 401k plan. Even the administrative expenses that we talked about earlier, where you're paying a third-party administrator, tax deductible business expense. So I encourage you to consider all those options. Employees choose how much to contribute in the 401k plan based on their salary deferral agreement, and the plan document's going to tell how much of their salary is eligible to put into the plan. Again, generally have to offer it to everyone who's age 21 and worked a full year and at least 1,000 hours during the previous year. Withdrawals, it's similar to other plans. If you take money out early and without a triggering event, you're going to pay that 10% tax penalty. And of course, the salary reduction, the part that comes through people's paycheck, their own contributions are immediately 100% vested. But again, if you use the profit sharing component, that part can be subject to a vesting schedule. So now we come to polling question number 2. What are the advantages to a SEP IRA plan for an employer? Awesome. Absolutely. You could also make an argument that answer 2 was a valid answer too, but answer 1 was the correct answer. Easy to set up and maintain. So now we'll go on to the next screen. So we talked about 401k plan. Now we're going to talk about adding what we call a safe harbor provision or feature to a 401k plan. And without talking about my bullet points, I just want to talk to you for a moment about this. So if you just have a plain old 401k plan and you have multiple people in the plan, there's the non-discrimination testing that's required at the end of the year. And one of the pitfalls you could find yourself in is that you as the business owner and maybe a couple of key employees who are highly compensated, maybe all of you maxed out your contributions into the plan. But maybe your rank and file put very little money in the plan. Maybe they only put in 1 or 2% on average of those who were eligible. So very little contributions by the rank and file, and very high contributions by the business owners and highly comp. When that happens, the non-discrimination testing could kick in, and the end of the plan year, your third-party administrator says, well, Mr. and Mrs. Business Owner, you put in $25,000 each, but because your rank and file participated at a really low level, you've each got to take $21,000 of that back out, and it becomes part of your taxable income that you're going to owe taxes on instead of it being treated as pre-tax. Well, that's not what you probably want. If you set up a plan, you probably want to be able to max out without any repercussion as a result of the high or low participation by your employees. That's where the safe harbor comes in. Basically, with the safe harbor, you're agreeing as the business owner to make a contribution into the plan, either a 3% contribution to every employee who's eligible, regardless whether they participate, or a match to those who choose to participate. And when we work with clients to try to determine which is best, we look at detailed census data, ages, income, turnover rate, attrition among your employees. We look at a variety of details to try to help you become educated as to which of these methods might make the most sense to you. The bottom line is, by applying one of these safe harbor methods and by making required employer contributions into the plan, you're buying the right to make maximum salary deferral contributions into your own account in the plan. And for any of your other highly comp employees who want to maximize their own contributions. So the safe harbor protects everyone's ability to maximize their own salary deferral. It's a big deal. When it comes to the safe harbor match, the two most common match combos that I see, one of them is the standard safe harbor match, as we call it, where an employee puts in 3%, you match them 100%, up to 3%. And on 3% to 5% of gross compensation, you match them at 50%. So they put in 3, you put in 3. They put in 4, you put in 3.5. They put in 5, you put in 4, and that's where it stops. And that what you're doing is you're agreeing to put in up to 4% as a match that way. The other method that we sometimes see as a match is an employer will say, well, I want to match 100% up to 4%. Well, 100% match to 4 is more generous because an employee only has to put in 4% for you to give them another 4%, and they got 8 total. Up here with the standard safe harbor match, they have to put in 5 of their own for you to put in your max of 4. And in that combination, they get a total of 9 into the plan. In most cases, I really recommend employers go with the standard match because it requires your employees to put more skin in the game. But that is subjective and you have choices on it. And in some cases, it might make more sense to do it one of the other ways. So the safe harbor provision permits high salary deferrals by those who want to make them. Allows any participant to maximize their salary contribution without fear of having it refunded at the end of the year. Top heavy and other things could still apply, so you could still theoretically have to make some other types of contributions. But if you have a good working relationship with your advisor and your third-party administrator, they're going to help you avoid any surprises at the end of the year. And then the safe harbor contributions that you put in, that required employer match or non-elective, that's always 100% vested. So if your employee leaves next week and you've made that contribution, they take it with them. It doesn't affect the profit sharing. You can have a safe harbor 401k plan, still make profit sharing contributions to that, and the profit sharing would be subject to a vesting schedule. So when we look at 401k plans, good fit for employers who want a more robust plan, has better features, but there are other rules and stuff that we didn't even get into that you can apply that make it even better, such as automatic enrollment, where employees have to affirmatively decline, otherwise they're automatically enrolled in the plan. Or you can have automatic increase, where everyone's percentage deferral gets bumped up by, say, 1% per year, which you're helping them prepare for their own retirement. So there are a lot of interesting features that can be added to a 401k plan or a safe harbor 401k plan. Now to move to defined benefit plans, where we're talking about a benefit during a paycheck during retirement as a result. It provides a fixed pre-established benefit at retirement. Any employer basically can set one up. You do need your third-party administrator, but you also need an actuary. And this is a legal term. It has to be somebody who is certified as an actuary to run the calculations in your plan. In a defined benefit plan, almost always 100% funded by the employer. And the max amount that you can put in is something that gets determined by the actuary, but you can put a lot more into a defined benefit plan than you can into a 401k plan or a 401k profit sharing plan by itself. And I'll give you a better example of that in a moment. So the employer makes required annual contributions as set forth in the plan document. When I say required, it's because you're giving yourself and your employees a predetermined benefit, and you need to fund that. And so you need to go into this, a defined benefit plan, with your eyes wide open. Yes, you're going to put money in it every year regardless. Generally, you have to offer it to all employees who've been with you a year or more, 1,000 hours, and age 21. Very much the same as a profit sharing or 401k plan. Triggering events for withdrawals, the same 10% early withdrawal tax penalty applies, and you can have a vesting schedule. I wouldn't do a defined benefit plan without a vesting schedule, because you're putting your own money as the business owner, you're putting your money into the plan for your employees. I would think you would want them to have to earn that benefit by following the vesting schedule. So we're to our next polling question. True or false, defined benefit plans generally must be offered to all employees age 21 or older who worked at least 1,000 hours during the previous year. Awesome, overwhelmingly got the correct answer, yes. Okay, here we go. So when we talk about defined benefit plans, to kind of continue the conversation, good fit for business owners with a relatively small ratio of owners to non-owner employees, and even more than in the profit sharing plan. Age disparity and wage disparity come into play here. But something that's really critical for you to understand is you need to have a well-established history of reliable cash flow for your business. Because when you set up a defined benefit plan, you're expected to fund it every year. And when we look down here at the special consideration, when you decide to set it up, you must expect and intend to make annual contributions for at least 7 years. Now, before that scares you away from considering a defined benefit plan, there are ways to escape out. The government's not completely numb to the possibilities of what all could happen. So let's say you set up a defined benefit plan, maybe a cash balance plan, which is a type of defined benefit plan. You set it up, and 3 or 4 years later, somebody comes along and makes you an offer that you can't refuse to sell your business to them. Well, if you sell your business, obviously the business is no longer going to exist. So that would be a way, a reason, a justifiable reason why you could terminate that plan after 3 or 4 years. The reason we emphasize this so much, though, is because of the nature of ERISA and trying to be fair in the way that retirement plans operate. ERISA, Department of Labor, expects that you're going to intend to maintain this plan into perpetuity, and that you're going to commit to funding it, because after all, that's what you've agreed to do, is to fund a benefit for your employees. So if somebody comes to me and says they think they want to set up a defined benefit plan, hopefully they're leading with the notion that they're going to fund the plan, and how much can they get into it over an extended period of time, rather than what's my escape mechanism. If somebody asks about the escape mechanism at the front end, I typically tell them up front, defined benefit plan is probably not right for you. So one of the more attractive things is, if you want to really get into the tax savings, is a combination plan. Typically, this is going to be a combination of a safe harbor 401k plan and a cash balance plan, which is type of defined benefit plan. It permits you to make salary deferral contributions, plus you can make employer contributions into both plans. So you could theoretically be making, everybody's making salary deferral into the 401k plan, but you could be making safe harbor contributions for everyone in the 401k plan. You could be making potentially profit sharing contributions, and also putting employer money in the cash balance plan. Where your third-party administrator and actuary are going to come to play here is they're going to work together to figure out what's the most tax efficient and cost effective way for you to do that, so that if your motivation as business owner is to max yourself out, they're going to help you figure out the right combination of money to put into either plan, so that you can get the most into your own account as the business owner, and still be fair within the ERISA rules with what you put in for your employees. Plans do have to be tested together, and the contribution amounts for everything other than the salary deferral and safe harbor have to be determined by the actuary. So you really need one firm to do all the third-party administration actuarial work together. I didn't list a number down here in max annual contributions. Instead, I want to give you a couple of examples of business owners who are, say, in their 50s, who set up a defined contribution or a defined benefit plan along with a defined contribution plan. So they've got a combo. They're running the plans together. And if they have you know, the max limit of income, at least 280,000 or more in your 50s, you may be able to get in the neighborhood of 200,000 a year into the two plans combined, into your own account. So if that intrigues you, you just need to keep in mind that there are administrative expenses involved, and you do have to make a long-term commitment to offering the defined benefit part of the plan. Again, same rules, generally age 21, 1,000 hours, and at least have worked for you for a full year. There are some nuances in the rules to where, depending on how your actuary has you funding it, maybe you put most of the employer contributions into the 401k part. You may be able to put in contributions into the defined benefit for only 40% of your employees. So if you don't have very many employees, the TPA and actuary can do some pretty remarkable things with that, with coming up with contribution amounts that are really attractive, huge tax savings for the business owner. Again, good fit if you have significant age and wage disparity, and you have both the desire and the means to max fund it. But again, key is that you need your third-party administrator and your actuary to work together, and the best way to do that is typically have them come together through the same actuarial TPA firm. Poll question 4, employer's role requires third-party administrator and actuary for combined plan design and document creation. So what's one common form that they must fill out for the two plans in a combo plan? Awesome, you guys did great. Awesome, it's a Form 5500 that's required. So if you're a high-income sole practitioner and you have no employees, and the way I see this is occasionally maybe an attorney who outsources for really minimal, say, administrative type function, bookkeeping or something, but that really is truly a sole practitioner, works on their own, that would be a good fit for what I'm about to describe. Maybe an emergency room physician who has their own professional corporation and they are the only employee of that corporation, and maybe that professional corp gets paid by a hospital or an ER services group. Maybe those kinds of things where you truly are a sole practitioner and you really don't have any employees. So you could have, in a simple plan, you could only get in 13,000 plus 3,000 catch up if you're over age 50, plus that employer contribution. So you can't get a whole lot into a simple plan. Same scenario in a SEP, you could theoretically get in up to 56,000, profit sharing up to 56. If you had a solo 401k plan and a profit sharing plan, sole practitioner could get in up to 56. If you were over age 50, you could add that extra 6,000 of catch up and get 62,000. In a combination plan though, which you can do as a sole practitioner, you could have a solo 401k, you could fund the salary deferral, the profit sharing, and your actuary would tell you how much you could put into a cash balance plan to go with it. And I've seen this very scenario where an employee could, or an employer, sole practitioner could start a plan, and in one case, for example, had Schedule C self-employment income of around 92,000 for the year, and was able to put into the two plans combined about 88,000 of that. Now, if you have to live off your paycheck, you may not be able to afford that, but where I typically see this is where maybe you have a couple, one spouse has a day job with really high income, the other spouse is a sole practitioner, maybe an attorney or an ER doc, and they may be able to really max fund the two plans. So it's not uncommon to be able to put a significant amount of your self-employment income into a combo plan, all the way up to in the 200,000 per year range. So that is something that can be particularly lucrative if that fits your profile. Oh, that kind of concludes. Amy, I'm going to turn it back over to you to go over this, and then we'll take questions if we have time.
Okay, so as we're reading the next couple slides, if you do have any questions, please use the Q&A box located on the menu bar at the bottom of your screen, or you can use the chat feature. As you can see on your screen, we do have a list of all of our upcoming June webinars. If you would like to attend any of those, feel free to visit our website, and we'll leave it open for a few minutes for questions. If you don't want to do a question here over the webinar, you feel free to contact Jeff personally, and he will get an answer to you guys.
On that note, I would point out, we tried to make this email box very user-friendly for events like this. So it's simply 401k@eidebailey.com. And we check it after events like this for incoming questions where someone has a specific nuance, maybe they don't want to ask about in front of a group or whatever. So feel free to shoot questions there. For anyone who does that today, please be aware that I will be on the road on business the next 8 or 9 days, and it may take us a week or more to respond following this event, but we will get back to you with an answer.
Okay, we did have one question come in. How aggressive can someone be on not having to do ER contributions to shorter term versus vesting? Or excuse me, via vesting.
How aggressive? Oh, I'm going to have you read the question one more time. I'm trying to think through this.
How aggressive can someone be on not having to do ER contributions to shorter term employees?
Well, you can only be as aggressive as the rules allow. So if I'm understanding the question correctly, there are a couple of aspects potentially to your question. So anyone who fits the criteria of being eligible, you have to include, and they would be included in the calculations. So the baseline on that is to say if they've been employed for a full year, worked 1,000 hours, and are at least age 21, you probably have to include them. And then the calculations are going to be based on, to a large extent, their percentage of the total payroll, their own payroll percentage against the total payroll. But you probably have to include them. The real question as to how much it's going to cost in total is how much do you want to put in for yourself, or how much do you want to put in total, and then get your third-party administrator to run the calculation and tell you how that would be allocated. So when it comes to doing profit sharing, to elaborate just a second more on that, you can either choose as the business owner to have them run the calculations to where you can say, I want to max out my own all the way to the 56 or the 62,000. Want to max it out. How much do I have to put in for everyone else if I do that? And they'll run the numbers that way and tell you for each person how much you'll have to put in. Or you can say, I had a good year. I want to put a total of 50,000 into the plan, for example. If I do that, how much of that goes to my account? How much goes to everyone else? So you can get your TPA to run the calculations either way.
Okay, one more question here. Can vesting of employer contributions be stretched to 0% for 3 years?
Yes, that's what's known as a 3-year cliff. And you can do that. So they are 0% vested until the end of 3 full years. And then on the next day after the 3 years have elapsed, they become 100% vested.
Awesome. Well, that is all the questions that have come through. We will send out the recording of this webinar within probably about 14 days once we get it edited and posted up on our YouTube page. If you do have any more questions, please contact Jeff directly, and we hope everyone has a great day. Thank you, Jeff.
Thank you. Appreciate everyone attending today.